Hello and welcome to this week's crypto update. So what's been happening in the markets? We're going to look at both macro and how that might affect the crypto space as per usual. So let's start with the macro because there has been a lot happening in that space over this past week. As we can see here, the Fed says the labor market's fine, but hiring has slowed to 2008 and 2020 levels. Jerome Powell will regret his decision to hold rates steady in July. Why? Well, 2 days after the Federal Reserve announced it would keep interest rates unchanged, the Bureau of Labor Statistics released a damning jobs report that shattered Jerome Powell's narrative that the labor market was still robust. The US economy added just 73,000 jobs in July, missing estimates of 100,000, and the unemployment rate rose to 4.2%. As weak as the headline figures appear, it was the fine print that confirmed the Fed's policy error. So what's happening here? Every month they come out with their labor figures and the job numbers. And the headline number is put out every month. And almost every month, those numbers are revised down. So let's say they go, we've created 100,000 jobs this month. Then, a few weeks later, after the headlines have gone out there, they revise those numbers down and down significantly month on month. So in other words, instead of it being 100,000 jobs being created, maybe it was only 20 or 30. But if they reported that for real at the time, the markets would react very negatively. And certainly if that was happening time and time again. So this is what has almost every month for the last 18 months has been revised down later. In this one, we can see even without it being revised down, they've missed the number very significantly. And it's likely this number of 73,000 will be revised down more again next month. But here's the real number. The real number is the government revised May and June data to eliminate a staggering 258,000 payrolls for the prior estimates, which according to Goldman Sachs marks the largest 2-month revision since 1968 during a non-recession periods. So basically what that means is if you were to take the initial reported amount of jobs created in May and June, added the two together and added the 73,000, that probably will get revised down, but let's assume it's correct for now, and you add those three together, and then you take this revision of 258,000 from that, you're left with just 7,000 jobs created over a 3-month stretch. If it was reported like that in the headlines, the market would take a significant pullback, maybe even crash off those numbers. Yet they're the real numbers. But because the headline numbers have been reported and everything has worked from that, the revised numbers almost happen in the background. This is amazing that this is how the system works, but it's how the system works. But ultimately what this is showing is there is actually weakness in the economy, all at a time when inflation still has not come down to their target point of 2%. Why does this all matter? Well, the Fed makes their decisions based on two key metrics by their own admission. One, the strength of the economy, and two, the inflation rate. They have stated they want inflation at 2%. It's currently at 3% and appears like it may rise. That's not usually on that metric on its own. That would suggest that they should be increasing interest rates on the other to try and slow the economy and slow inflation. On the other hand, when you take the economy, if the economy is strong, again, you would increase interest rates at the time when you get the opportunity in order to, have money on the side if the economy reduces. Right now, we've got the worst of both worlds. We've got increasing prices with inflation and we've got a weakening economy. For one, you should be reducing interest rates. For the other, you should be increasing interest rates. Ultimately, the Fed is going to now have to make a decision between fighting inflation and saving the economy. Most believe at some point in time now, the money printers will come on and they will reduce those interest rates in order to save the economy. What will this mean for inflation? Most believe that will cause it to go up, which means we enter a stagflation, potentially where you have a weakening economy and increasing prices. Not the best outcome for risk on assets. But if we look at the crypto side, what's been happening. So the start of August, well, the crypto market got smacked with a brutal 1-2 punch. Nearly 1 billion in ETF outflows and a sharp sell-off in both Bitcoin and Ethereum. Why? Well, on Friday alone, the spot Bitcoin ETF saw 812 million in outflows, the second largest single-day outflow ever. Ethereum ETFs snapped back their 20-day inflow streak, bleeding 152 million, and Bitcoin dropped to 112,000, while Ethereum fell 3.7%, mirroring broader market jitters. So overall, we're starting to see a sort of a risk-off scenario in the short term as a reaction to a number of items. Number one, of course, what we've just covered, the sort of general risk-off sentiment when you see this type of jobs report. The US jobs report was a disaster. July saw 73,000 jobs added, with 258,000 job downward revision for May and June, as we just covered. Long-term unemployment jumped and confidence tanked. That's one reason. Number two, the people that bring forward these numbers, Donald Trump actually fired the head of that because he's basically saying, well, if you're getting these numbers so far wrong for so long, someone has to answer to that. And of course, the other one is no one likes nuclear talk. So there's the nuclear rhetoric has escalated, and Trump has said, based on highly provocative statements on the former president of Russia, I have ordered 2 nuclear submarines to be positioned in appropriate regions. And of course, nobody, including the markets, likes to hear talk of potential nuclear action. So these are why much of the market has reacted negatively. We've seen a significant pullback in both the S&P and, of course, crypto in general. So, of course, the overall macro always has to be taken into account as we speak about Bitcoin, Ethereum, and the rest of the market. However, within crypto, it's mainly positive news. So there's just 15.35 million ETH now sitting on exchanges. That's under 13% of the total supply. And in the past 90 days alone, over 2 million of those have left. That's about 7.7 billion in value has been pulled off exchanges. And as it comes off exchanges, it's seen to be taken away from the potential of being sold anytime soon. This is huge. Exchange balances now are fast approaching 2015 levels. So we're getting to a point where there's a really small amount of Ethereum potentially available to be sold on exchanges, all the while it appears that demand for Ethereum overall, bar the little pullback we've just had, is growing. What could cause it to grow even further? Well, according to Nate here, the SEC says certain liquid staking tokens are not securities. They'd been deemed to be securities all along. That's changing. This he sees as being the last hurdle in order for the SEC to approve staking and spot Ethereum ETFs. This could be the final unlock for Ethereum ETF staking. What does that mean? Institutions are already moving towards Ethereum very rapidly over the last few months because they want to have part of the potential upside of the asset price of Ethereum. What will really cause a rush for institutions to come into this is if it also can generate a yield at the same time. If you can stake your Ethereum, you can generate a yield. If ETFs are allowed stake, which is looking likely now, then those institutions can take part in the potential upside of the asset value, but also earn a residual income from it. This is a huge opening for a gush of more money from institutions into these ETFs and likely create even more demand for Ethereum. All the while, Ethereum has the least amount of it available for sale on exchanges. This would tend to lead to a very positive movement in the asset over time. Of course, can the overall economy hold and at least stay stable? If so, I believe it'll be hugely positive end of year for both Bitcoin, Ethereum, and probably the broader altcoins. But that is the big question. We also see here with Bitcoin, Brazil's lower house to hold hearings on creating a national Bitcoin reserve. Brazil has set an August 20 hearing to debate a bill that proposes to allocate up to 5% of national treasury funds to a cryptocurrency reserve. There's one of these coming out, it feels like, nearly every day. We also see here that Indonesia is exploring a national Bitcoin reserve. So ultimately what we're seeing here is more and more build-up of potential demand for the likes of Bitcoin, the likes of Ethereum, and over time it would appear that the value of these are going to go up. Having said that, it all depends on the macro event and the macro environment. Can the overall economy hold steady at minimum or even look positive? If it were, and we get money printing at the same time, then it's highly likely we see a really strong end of year. But point of notion or caution at the end, here is a chart of Berkshire Hathaway's cash position, and it's now at 30%. Of their total assets, the most in history. And if you can see in the chart here, the last time it was moving towards these levels in around 22 billion was on the move into the last financial crash of 2007 and 8. Are they positioning themselves into ahead of what they believe will be the next financial crash? Who knows? But it's certainly worth bearing in mind. Now, hopefully you found all that useful, and we'll talk to you all on the next one.